Well, Treasury Secretary Janet Yellen sought to reassure lawmakers on Capitol Hill today after the chaos in the banking system this week. And now in a testimony before the Senate Finance Committee, Yellen touted the government's recent actions to prevent contagion from spreading. Yahoo Finance's Jennifer Schonberger joins us now from D.C. with the latest on that. Hey, Jen.
Good afternoon. Treasury Secretary Janet Yellen assured Senate lawmakers this morning that the U.S. banking system remains on solid ground despite the failure of 3 banks over the past week. Yellen said regulators took emergency action in the wake of the failure of Silicon Valley Bank because they were worried about contagion risk and that more banks might fail.
Well, in the sense that the chances of contagion that other banks might be regarded as unsound and suffer runs seemed extremely high, and the consequences would be very serious.
Yellen noted that Silicon Valley Bank had a very high ratio of uninsured deposits and that banks with insured deposits usually don't encounter runs. Yellen said policymakers need to re-examine rules to ensure they address the risks the banks faced. When pressed by Senator Elizabeth Warren to strengthen capital rules rolled back in 2018, Yellen noted that the Dodd-Frank supervisory stress tests focus on capital requirements, not liquidity, and that with these bank failures, liquidity played an important role. Yellen said regulators need to examine the liquidity requirements needed for a bank with such heavy reliance on uninsured deposits that are, quote, runnable. Now, while Democrats pointed fingers at Republicans for rolling back capital requirements, Republicans blamed regulators. Senator Tim Scott.
It appears that the San Francisco Fed was asleep at the wheel. They failed to meet their basic, not enhanced, but basic supervisory responsibilities and therefore missed their opportunity to use enhanced supervisory tools if necessary. Instead of taking accountability for this blatant failure, regulators are now forecasting that they plan to increase regulations on the rest of the banking industry. In other words, the banks that made responsible business decisions and have not failed.
Yellen says she's monitoring stress in the banking system to make sure that the problems with Signature and Silicon Valley Bank don't spread to other banks in the banking system. She says she's most concerned right now about stress in the banking system and the potential for capital and liquidity to dry up that could cause banks to cut back on lending, making credit more expensive and less accessible. Shauna?
All right, Jen Schonberger, thanks so much.